Hello and welcome to ET Now. You're watching IPO Central and my guest today is from WeWorks India Management, Karan Virmani, who is the MD and CEO of the company. Karan, thank you very much for joining us on ET Now. Your IPO is opening on October 3rd, price between 615 to 648 and you're raising 3,000 crores through offer for sale. Why not fresh issue? You don't need capital?
As we built the business over the last 8 years, WeWork has been through crazy journey. But one thing that we were very focused on, even pre-COVID, was getting this business to be self-sustaining and actually delivering enough cash flow that it can actually sustain its growth. Today, we're gratefully in that position where over the last year, if you see our EBITDA margins, which are upwards of 22%, roughly about 420 crores of EBITDA that the business generated on a revenue of close to about 2,000 crores, is more than enough cash that the business requires to sustain a pretty healthy growth rate, which is over and above what the industry is sort of growing at. And today, with the cash flows of the business, we're in a very comfortable position to continue to keep growing the business, which is why we're not raising any fresh issue today in the IPO.
You spoke about the EBITDA margins, and that's primarily because of the kind of asset heavy business that you carry, right? In that sense, otherwise the EBITDA margin should have been a little more higher in that sense.
Not really. It's because we have created operating leverage in the business. So just to give you, a sense of how our business model
as
works,
compared to others who are already listed.
Yeah, I mean, I will try not to compare too much with others, but what we do is we go into the best micro markets in the country, best cities in the country, in the best assets, and we usually end up taking some large scale space on lease. We then put our design, our thought behind how to build a space for any type of business, and put in capex into that, and over the course of the next few months end up actually ramping that occupancy up, where we're leasing space to basically small companies, mid-tier companies, and some of the best enterprises and large-scale enterprises in the world. Over and above just providing the workspace solutions, we're able to provide services that allow businesses to take away a lot more inconvenience that they have while growing a business. So this could be things like F&B to managing your events. When you have a town hall or an investor meet, our team is able to actually curate that entire thing for you. Dedicated internet, dedicated lease lines, customizing your workspace. This services part of our business, is roughly about 11 to 12%. And then over and above that, we've created a new revenue stream which is driven by our digital products business, which allows us to actually create better utilization of the asset itself while providing customers with a product that allows them to just pay for space for a day. So for as low as 500 rupees a day, you can access a WeWork location, come use our space, get connected to the internet, have free tea, coffee, build your startup, do your work while you're in the office. And that part of our business is a huge margin driver for the company. So as occupancy fills up, as we're able to generate services revenue and also generate digital, grow the digital business, we're seeing that the margins are able to move from what is maybe industry roughly about 10 to 13% to our 22% EBITDA margins that we have today. So it's not driven by the pure fact of just putting capex in. It is the value that we're bringing by being able to design spaces a lot more efficiently and also have those fill up along with all of these other revenue streams.
The industry is divided between people who have or companies who have asset heavy business models like yours where you're putting upfront capex there, and others who have a lighter asset model where they are going to joint development or revenue share methods which is there. Why you have chosen the other way, asset heavy instead of being asset light?
So look, for us it's actually a risk reward conversation. our focus strategy, the way that we are growing and where we are growing, is to be in the top micro markets, in the top cities, in the best assets. And the reason that's where we want to grow is because that's where all of the demand actually is. That's where some of the best corporates, the best multinationals in the world, best Indian corporates, best startups in the country want to be. The heart of BKC, the heart of Cyber City Gurgaon, CBD Bangalore, High Tech City Hyderabad. These are extremely high demand locations where majority of all commercial leasing in India actually continues to happen, and where landlords are delivering that capex. And because we feel like there is always going to be high demand, we feel like the risk is extremely low when we actually put in the capex, but the reward is extremely high. Typically, when you ask a landlord to put in the capex, you also have to share the margin and the revenue with the landlord. We want to keep all the revenue and margin because we truly believe that these are spaces that will always be in demand. Even in a down cycle, a BKC will always have need for space, or people will always look to grow within those micro markets. We have done asset-light deals with landlords. We do have certain locations which are operator-led, where we just take a share of the revenue. These are typically in locations where we haven't had the kind of confidence that we would have in terms of the demand being sustained, or we weren't sure at that period of time that there will be sustained demand. So the first approach we took was, maybe an operator-led deal. And this is where the landlords have invested. They get to keep most of the profit and the margin, where we just take a small share of that. Our brand and our product can do either of those products. We are not limited. It just becomes, where are we willing to take the risk and also enjoy the reward.
No, I'm asking this because you have lease rentals which come in, and that's depress the profitability at the bottom or the bottom line because of that. Isn't that going to be an issue for investors? Because as you scale it up, or you're building up a center, the cost has to be upfront through the P&L, and that would suppress your profitability.
So if you look at our business, let's say when COVID hit, our break-even occupancies of the business were upwards of 70%, which means we had to get to about 70% occupancy to even make money. Today, those are like in the range of 50 to 55% in terms of our break-even occupancies. We typically get to a 80-ish% occupancy within the period of 12 months. So within almost 4 to 6 months, we're already crossing these break-even occupancies. So the risk that we see is quite minimal. In fact, sometimes we'll open with a high opening occupancy that negates this need or this ramp up risk at all. Today, our growth portfolios are actually growing or breaking even faster than the existing cohort. So the risk continues to come down while we are able to mature these assets, which is anything over 12 months at roughly about 85-ish, 83 to 85% occupancy. We have buildings that are even sitting at 100% occupancy. So the margin in the business or the asset level is anywhere from that break-even point of 51, 55% all the way till this mature, occupancy, which gives you at a mature level, building occupancy is upwards of basically 30% right? That is something that we've worked on over the last few years and basically been able to bring it down. So the risk is sort of really mitigated. And post that, as buildings sort of like are sitting at higher occupancies, when we're able to sell services and all of that, we are able to see this margin expansion happen. So if you look at us at a company-wide level, we are operating at about 22% EBITDA, occupancies as of last FY, and that is at a time where we are expanding capex at a rate which is higher than we have in the last 4 years. Last year, we had the highest amount of capex expansion we've had even since pre-COVID. So you're able to see that the even while bringing on all of these assets, these lease costs, we're able to actually deliver significantly higher margins than anyone else in the industry.
What is the kind of capex that you have lined up for the next few years, and how many more seats are going to come in as that? What is the expansion strategy like for you?
So if you look at commercial leasing in India, it has been growing at its highest peak. Last year was the highest amount of commercial leasing that India had ever seen, almost 77 million square foot. 95% of that happened within the top 8 metro cities, within 30 micro markets within those metro cities. Today, we're in all of those 30 micro markets, and our focus will be to continue to expand and go deeper within those micro markets itself. From a expansion standpoint, if you look at the industry over the last few years, is growing at roughly about 18 to 20%. We as market leaders will continue to grow a little bit faster than that, and that roughly amounts to about 20,000 desk addition year over year. And our cost per desk today is roughly, as of Q1 of this year, is about 1,30,000 or a little over 1,30,000. That puts you somewhere in the range of between 250 to 300 crores, of capex for last year that we actually delivered in terms of expansion, and we think that that's something that will continue year over year.
So the cash flow that will come in on a yearly basis, that's enough for yearly expansions for you?
Yeah. Like I mentioned, last year on a revenue of 2,000 crores, we delivered an EBITDA of about 420 crores. That is the cash flow that the business is generating, which is more than sufficient. We'll see that EBITDA grow this year as well, while revenue continues to grow. And, at the end of the day, we're also able to access cheaper forms of debt if we require. But today, the business is able to sustain the capex that it needs.
The relationship with Embassy Group, you're part of the Embassy Group. Yes. Do you have the first right of refusal for assets coming up in the group?
Yeah, so if you zoom out at the group level, at the Embassy Group level, once WeWork is listed, we will actually have 3 major listed platforms. The Embassy REIT, which is growing in an annuity part of our business. We now have Embassy Developments, which does all of our ground up land to fully leased out developments, both on the commercial side as well as on the residential side. And you'll have WeWork, which is a services or real estate services, business as well. And the idea always is that all 3 of these platforms work together, in a strategic manner. So we do today lease a lot of space from the Embassy REIT. About 20% of our portfolio sits with the Embassy REIT. We're in the top 10 tenant list, for that business as well. We will continue to take space where it makes sense for us in assets that the REIT, continues to have. And 100% the strategic advantage of owning the real estate and having that, platform is to make sure that, we are able to get the best space. However, everything we do is on an arm's length basis, and we follow, proper governance when it comes to that. So it has to make sense for the REIT as well as us if we're looking at taking.
Your relationship with WeWorks, it has changed hands multiple times in the last many years actually. Yes. How is it? And at some point in time, is WeWorks or the parent who would like to exit? Because there is a royalty relationship which you have with respect to WeWorks now.
So WeWork India started off as the first ever franchise location for WeWork globally, where we believed in the brand and the product. And as Embassy, we had this local operational expertise of being able to source, find and operate real estate. So bringing the best of 2 worlds together, has delivered immense value for both Embassy as well as now for WeWork Global, where WeWork Global today, after investing about 100 million in 2020, owns about 22% of the business. Through the OFS, they will be selling pro rata along with us. From a partnership perspective, Anant Yadi, who's now the new owner of WeWork Global, is an extremely strong partner. They have been extremely constructive, through this process. I think there is clear indication of the amount of value left to be created in India today. So I don't foresee, any major reduction in the stake post today's IPO. our royalty payment will continue. That royalty payment gives us perpetual exclusive rights of the WeWork brand, IP, technology, and access to all spaces for our members globally. So just imagine that if you're a member with WeWork here, you get access to 600 locations, globally. You're able to actually deliver for some of the best multinational businesses across the world a solution that doesn't only give them a solution in Bangalore or in Mumbai, but gives them a solution across 120 cities. And for that we pay a small 2.5% management fee.
My final question to you is, in December you acquired some stake from WeWork's parent, Ariel.
Yes.
It was around 460 or odd rupees or so, and you're coming out with an IPO at 648.
Yeah.
What has changed between two in 9 months?
Well, actually, so while we did buy some amount of equity from WeWork, we as Embassy did a rights issue actually at a higher price than what the IPO is going in at. So we've actually left a lot of money on the table even post the rights issue which we did in January, where we invested about 500 crores into the business, used that capital to pay off a huge amount of high cost debt. And today we're coming with an IPO that is actually lower than the value that the promoters actually put in the money at. That just shows you how we're looking at the business, how we want investors who are coming in to actually, create huge amount of value. And just like me and my team have done for both Embassy and WeWork, we're committed that any investor coming into the story today, we will be working day and night to make sure that everyone creates value through the story and do what's best for the company.
And this OFS would be used by the promoters to pay off the debt for the rights and the acquisition costs from WeWorks or the Ariel, basically.
Some part of it, yes. The other part is definitely going back into strengthening the group itself. So while a large part will be to pay off debt, we want to use that also to be able to strengthen all of these three platforms, and as Embassy Group, be an extremely strong, diversified real estate player in India today.
Karan, it was a pleasure talking to you today. Your IPO is opening on 3rd and closes on 7th. Price between 615 to 648, yes. And 3,000 crore IPO, and that values your company at little over 8,600 crores. Thank you very much for joining us on ET Now today.
Thank you so much.